Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor. In fact, I'm an investor in general. I hold index funds, I hold property, I hold all sorts of investments. But one of the things that I do love are index funds, and I'll go through why. And today I'm presenting you the 10 rules by Jack Bogle on investing. And I think this could be one of the most important videos that I put out there. So I would urge everybody to watch this one through. It's really, really important. If you're new to the channel, please bear in mind we don't sell any courses here whatsoever. That's our USP. We don't ask you for anything. We just bring you as much information as we possibly can. So if you are new and you'd like to subscribe, please consider subscribing and give the video a big like, regardless of whether you're new or not. But let's get into the video. And before we do, a couple of people have asked me to zoom in on the board a little bit. So I'm going to do that and see if I can get a bit of a better view for you. Let's see. How's that? How's that? Can you see that okay? I think that's going to be okay. So 10 rules by Jack Bogle. Let's go through it. Who is Jack Bogle? Well, he is the founder of Vanguard. Now that's the second largest asset manager in the world. After BlackRock, I think is the largest. So 7.1 trillion under management, a huge number. Now a couple of their ETFs that you'll be able to find, VUSA, VUKE. Now that is the USA S&P 500 and that is the UK 100. So let's talk a little bit about what an index fund is very, very briefly. And then we'll go through the 10 rules and we'll work out exactly what we can learn from this amazing man and exactly what he's achieved in the past. And I'll give you an interesting fact about Vanguard. Vanguard is owned solely by the funds that it provides, which means if you buy a Vanguard fund, you own part of the company. It's an absolutely fantastic structure of a business which basically incentivizes the business to keep the fees as low as possible. And that's what Vanguard was really founded on. The lowest possible fees to the consumer to make sure that instead of the shareholders making money, the shareholders became the consumer and as such, they made the money. And low fees is what Vanguard is all about. Now, in terms of index funds, what are index funds? Let's look at VUSA. Now, VUSA is the S&P 500, and that is essentially an index of 500 of the largest companies in America. And if you own the index fund, you own a proportion of all of those 500 businesses. And as businesses become more valuable, you automatically will buy more of them. And as they become less valuable, you will automatically sell them down and hold less of them. So with that in mind, it is constantly adapting and you should be getting market returns. So the idea of owning an index fund is essentially to provide you with market returns. And there's many reasons for that. And I'm going to go through the 10 rules and that will highlight why holding index funds is such a powerful strategy. So Jack's very first rule is remember reversion to the mean. And what essentially this means is you can look at a basket of fund managers and you'll be able to, over a 2-year period, find a significant amount that will outperform the market. Now, if you look at a 5-year period, that amount reduces. Now, when you get to 10 years, this is where it gets really interesting. Only 20% of professional managers will outperform the market. Now, if you take a 15-year view, it becomes very, very slight. I believe it's something like 5% of professional managers manage to outperform the market and only 1% of individual investors over a 15-year period. Insanely low. So reversion to the mean essentially means the stocks that are hot today and the managers that are hot today will not necessarily be hot tomorrow. And over a long enough period of time, almost everybody reverts to the mean. So there's no real need to take the risk of being able to pick that superstar fund manager for the next couple of years. If you're investing for the long term, why not just own the market at a low fee cost and over that period enjoy market returns? So the very first point is remember the reversion to the mean. Ultimately, not many people will be able to outperform the market over a significant period of time. Second point, time is your friend. Again, he says that trying to time the market is almost impossible. Much better to hold for a long period of time and allow compound interest to take effect. Now, I'll put a link in the description for a compound interest calculator. Use it, they're absolutely fantastic. But ultimately, if you're gonna get 7, 8%, something like that over a long enough period of time, time is definitely your friend. fund. Now the third thing is to buy right and hold tight. The market fluctuates, it changes all the time. John or Jack says make sure that you buy right, i.e. set your allocation correctly to where you're comfortable, and hold tight. Do not change that allocation. He's very, very specific about that. He says that over a period of time, over a long enough period of time, as long as you buy right and hold tight, so that means buying index funds that represent the allocation that you would like. So if you just want to be USA focused, VUSA would be the one. If you want to just be UK focused, VUKE would be the one. Both of those would be the equivalent if that's where you want it to be weighted. Myself, now I've got about 5 that I like to have, which is VUSA, VUK, there's an emerging markets one which I actually use, an iShares one, which is a BlackRock product, and that's only because the fees are slightly lower, and we'll go on to that in a minute because number 6 is minimize the croupier's take, and we'll understand why. But I have like emerging markets, I have USA, I have FTSE 100, I have an international index, and I have a bond fund, but I only put a very small amount into bonds. So with that in mind, there's 5 that I really look at, and I'll do another video on my allocations later on. But buy right, hold tight, don't go selling halfway through a recession, just keep putting in the allocated amount that you've said that you're going to put in every month. Number 4, have realistic expectations. Now I think this falls through to every part of investing. Having realistic expectations is key. Now I can tell you right now, you're going to, in the stock market, average over a long enough period of time between 7 and 12%. And Jack, he calls himself both. So Jack Bogle, he also goes into how that happens. And essentially, there's normally 3 to 5% of earnings growth, about 2 to 3% on dividends. And then on top of that, there's also inflation and all the rest. So 7 to 12%, that's about where you're going to be over a long enough period of time. Now, having realistic expectations, I think that really falls into it at the moment, and some of the themes, because some of the crypto investments, 1000%. Is that realistic over a period? Well, you just need to do the maths and go, well, if I invested £100,000 and held for 3 years at that sort of rate, I would have all the money in the world. It cannot be. It isn't realistic. It cannot be the case. So for me, having realistic expectations is key. And in property, I like 10% is what I'm looking for on a rental yield for a single let, 15 to 25% on a HMO, and in terms of capital appreciation, 5 or 6% is what I'm expecting. At the moment, we're exceeding that. As you can see up here, we've done really well over the last 6 months. I think we've added nearly 5% in 6 months, which is absolutely crazy. But I don't expect that to continue. My realistic expectations on property is 5 to 6% growth per year and rental yields of 10 to 25%, depending on how complex the business I'm putting within the property is. Nice simple single let, 10%. That's a really good ROI. So realistic expectations. Number 5, forget the needle, buy the haystack. Now that's really saying when you buy these big index funds, you're buying all of the companies within it. Don't try and search for the one that's going to be the next hot ticket. Buy the haystack. You will automatically buy that hot ticket as it starts to rocket, and then as the index fund rebalances. I think that's a fantastic concept, and it's something that I really buy into. I would say that's the second main reason why I like index funds. And the first reason, the most important one for me, is number 6, minimize the croupier's take. Now, I thought this was absolutely fantastic. I watched an interview with John, and he essentially said that if you had a 1% variance in fees, so for example, if you paid 1% more over the course of a 25-year period, and he took an example sample of money, but what it essentially led down to being 1% was equal to the following. You staked 100% of the money, you took 100% of the risk, and when it came to the rewards at the end, you got 1/3, and Wall Street or Canary Wharf or whatever institution you paid got 2/3. And that was because on the years where the value of your portfolio went down, they still took 1.5%, 2%, whatever the average was. There was a 1% difference, and this is what happened. And essentially he says, and I buy into this massively, minimizing the amount that you pay in fees is key. So I use ETFs because in my Hargreaves Lansdown platform, they're absolutely free for me to hold. hold because I have more than £10,000 worth, which means I pay £45 a year for the HL platform. And then on top of that, I only pay whatever the management fee is, which is very small. VUSA, I think it's 0. Someone's going to get me in trouble here, but it's something like 0.8, and VUK something like 0.7. It's very, very small. So you're paying very, very small fees in order to have market returns. So for me, minimizing the croupier's take or minimizing the fees you pay is absolutely key. Number 7, there's no escaping risk. Markets go up and down. Stay the course. Do not be afraid. There is no escaping risk. I accept this. So set the amount that you're going to do, forget it, allow it to just compound. It's going to take care of itself. But people who try to escape risk by not investing, for example, when it's at market highs like the S&P 500 is now, you don't know which direction the market's going to go into. You've got to assume the risk, you've got to take it on, and when it's at record lows, you've got to take the risk at the same time. Over a long enough period of time, it evens itself out. Number 8, don't fight the last war, and this is essentially saying whatever was hot yesterday may not be hot tomorrow. Don't try and fight the last war. There's no point. And again, I think this harks back to time is your friend, buying right. I mean, these all tie in together so nicely, and this is why I love these 10 rules. The last 2. Number 9, the hedgehog beats the fox. And in this analogy, the fox is sly Wall Street with all their fancy algorithms, but ultimately the hedgehog just curls up into a bowl, protects itself, and the index fund in this scenario isn't trying to outbeat anything, it's just accepting what the market returns, and ultimately the hedgehog, over a long enough period of time, always beats the fox. And the last one, and the most important one, guys, stay the course. Set an objective, understand how long it's going to take you to get there, be realistic with your expectations, buy right, hold tight, stay the course, and you will reach your financial goals. There's no reason why the maths won't work for you. So for me, guys, those are the 10 rules. I would absolutely recommend looking into Jack Bogle. Fascinating character. Vanguard, as I said, I think is a fantastic business. I'm not sponsored by anybody. I'm completely independent. I don't sell any courses. I don't sell anything, so there's no reason for me to pitch something over anything else. I use iShares, which is BlackRock's one, for a couple of them, but most of my holdings are in Vanguard because the fees are just so low. So guys, I hope this video has been useful for you. If you have enjoyed it, please give it a like, subscribe if you haven't already, and I'll see you on the next one. Cheers, guys.